Hello everyone, I'm Dr. Bharati Sunil. Welcome to our Finance and Accounting Academy channel. Have you ever asked yourself why some investments give high returns while others result in losses? The answer lies in one important concept, risk. Just like fire helps us cook food, but also can cause accidents. Investments offer opportunities for profit, but also carry the possibility of loss. In this video, we will understand the meaning of risk, why risk matters, the different types of investment risks, and the difference between systematic and unsystematic risks. I will explain all this with very simple examples. Let's get started. Risk. Here first we will discuss about everyday risk so that you will understand the concept what is risk. Later we will get into the topic risk in investment management. What is risk? Risk exists in our daily life too. So you will see many situations. Say for example, if you want to go to college by bike and you want to reach quickly, then what you will do? You will drive very fast. So what benefit you will have here? You will reach your college quickly. But what's the risk? There is a possibility of accidents, right? In the same way, if you take the example of investment, what is the benefit that we get? Higher return. But what is the risk we are having? We are having the risk of probability of getting losses. So now if you talk about risk and investment management, you may get higher returns, but there is a risk of loss possibility. Now you know that risk is a part of everyday life. So this can be there in any time, like when we travel or when we buy any new things or when we invest money, right? So risk is the possibility that our actual outcome may be different from what we have expected, right? So how it will happen? Say for example, you bought some product online, right? So when you have placed order, the color, the everything is very nice, but when we have received, that is completely different. Means either it is a faded color or it is damaged product or whatever it is. When this undesirable consequence can happen, in that situation, what is that called? It is called risk. Now we'll discuss about fire. How fire is used in our daily life. We use fire to cook food. So if you use fire in the proper manner, we can cook food deliciously, right? Say, what is the risk of this fire while cooking food? If fire is not properly used or controlled, right, it may cause burns, injuries, or a fire accident. So, for using fire, there is a benefit that we will get delicious food, but at the same time, there is a risk that there is a chance of causing burn or injuries. In the same way, if you take electricity, just imagine, can you live our life without electricity? No, it's not possible because we require electricity for lights, fans, ACs, and the very important thing is we want for internet. As you all know, without internet we cannot do any works now, right? It has become so mandatory in our life. So this electricity, if you are using for these type of amenities or facilities, we'll be very happy. If the electricity is not properly used, then it may cause electric shock or short circuits or fire hazards. So risk is there everywhere, but what we have to understand here, we have to use that properly. Now I'll come to what is investment risk. So here I will explain you about investment risk. Till now what we have understood about the general risk what can happen in our life. When we are investing our money, we are having one advantage that we will get good returns. But at the same time, we are also having risk. What is that risk? Risk here means there is a possibility of losing our money, or we may earn lower returns than what we have expected, right? So always there is volatility. if you see here, you can observe sometimes it is rising, sometimes it is falling, means there are lot of fluctuations, means there is volatility, right? So in this case, can you expect your returns? No, we cannot expect. Sometimes we may get more than what we have expected, right? Sometimes we may get less than what we have expected. This is called what? Risk, right? So higher the unpredictability, greater is the degree of risk. Why risk matters? Now you know that investment is having risk, and investment is also having some degree of uncertainty. So first of all, what is uncertainty? Uncertainty means when the possible outcomes are not known to us. Means we can't predict anything here. So it's completely what? Uncertain. Then what is risk? Risk means here you know the probability of possible outcomes. So if you take the example of risk, say when we have invested some amount in shares, there's a chance of earning profit or incurring loss also. So simple example I want to give here. If a coin is tossed, there is a 50% chance of getting heads and a 50% chance of getting tails. So the probabilities are known. So it involves what? Risk, right? So if you take this in investment management example, say if you invest in shares, there's a chance of earning profit or incurring loss, right? So based on past market data, investors can estimate the likelihood of these outcomes, right? So now if you take the example of uncertainty, say for example, if a company is launching a completely new product into the market, right? So they cannot accurately predict customers' response because there is no past data available. In the same way, can we predict the impact of future technology breakthrough on a particular business? No, it's very difficult because the outcomes and probabilities are not known to us. These are all what? Unknown. So this is called what? Uncertainty. Now you see here risk in investment management. Say if you have invested rupees 10,000 in one investment, there is a chance of getting 15,000. You can see in green color gain. And there is also a chance of losing our investment when we are receiving only 8,000. But how much we have invested? 10,000. So what is the loss here? We have made 2,000 loss. So this you can see red color. So what you can understand here, if you make investment, there is a possibility of gain or loss. In investment management, you can understand risk in two types. First one is called systematic risk or non-diversifiable risk. And what is second one? Unsystematic risk or diversifiable risk. So first I will explain you what is systematic risk. Systematic risk means if you take your company as example, your company is perfect in all aspects, but still your company is facing risk. Why this risk got caused? Because of entire market or economy. So systematic risk is encountered out of external and uncontrollable factors that are happening in market or economy. What are those factors? Like market sentiments or proneness of industry to booms and recessions, or governmental policy changing in the state economy, the threat of war, which are all not under our control because it got affected because of external factors. This type of risk cannot be eliminated through diversification because all companies and industries are affected simultaneously along with us, right? Systematic risk is also called what? Market risk or economy wide risk, or it is also called non-diversifiable risk. Systematic risk means it is not caused because of us, but it is caused because of external factors. Coming to Unsystematic risk. So what is unsystematic risk? A company's specific risk, and it is controllable if proper measures are taken. If a particular company or a particular industry or a particular group of companies are facing this risk, means it is completely diversifiable. As you know that it is unique risk to a particular company or to a particular industry or to a particular group of companies. And how this will happen? Because of industry factors like labor strike or management policies. So in that case, investors can reduce risk by investing in other companies, not in these companies. If investor knows about this particular companies or industries risks, then what he can do, he should either reduce that investment in this particular company or in this particular industry, or he should completely go to other type of companies and other type of industries. Unsystematic risk is also called unique risk, company specific risk, and diversifiable risk. Now you know that unsystematic risks can be controlled. For your clear understanding, I gave systematic risk as MIIL. Means what? Systematic risk covers market risk, interest rate risk, inflation risk, and liquidity risk. And unsystematic risk covers what? Business risk, financial risk, and credit risk. This I will explain in detail. Now you can see in this slide systematic versus unsystematic risk. So the systematic risk is called what? Market risk, which can be diversified. What are covered under this? Inflation, interest rate changes, recession or economy slowdown or war, pandemic, and government policy changes. That all will come under what? Systematic risk, which are not under our control, which we cannot eliminate. This risk we can't eliminate through diversification, right? Next, coming to unsystematic risk, this is completely company specific risk. This you can reduce through diversification. What are the examples that we can take here? Employee strikes, poor management decisions, product failure, business losses, company fraud. All these are under our control. If you manage our company properly, then we can reduce these risks. Under systematic risk, first we will cover market risk. So what is market risk? Market risk arises out of changes in demand and supply pressures in the market. Here you can understand the factors that are causing market risk are the psychology and sentiment of individuals, also cause some market fluctuations which are uncontrollable. Here in this example, in this slide you can see during the COVID-19 pandemic, many stock markets got affected. If you take before COVID-19 pandemic, market was moving upward. But what happened after COVID-19? Market fell sharply. So market got affected. So you can observe from January 2020 to March 2020, there is uptrend, right? So from March 2020 to April 2020, there is downtrend in the market. So this is caused because of what? Market risk. Now coming to the next one, inflation risk. What is inflation risk? Inflation risk is the risk that is caused because of rise in prices. If the prices are rising, then our purchasing power will be reduced. Means it will be decreasing. If you see the example of inflation risk, today if you can buy 5 notebooks for rupees 100, after few years, because of inflation, for this 100 rupees you will get only 3 books. Why? Because the value of 100 rupees is decreasing because of inflation. So due to inflation, what will happen? The value of money decreases over time. So you can buy less books with the same amount of rupees 100. If you are making investment of rupees 1000, you may get 6% return. but the inflation rate is 8%, then what will happen? Because of inflation, the investor loses real purchasing power, because the returns whatever you are getting, that percentage is less than inflation rate. Say if you take the example of fixed deposit investment, because of inflation risk, what will happen? Say you have invested 1 lakh in fixed deposit, which is earning 6% interest per year. But if the inflation rate is 8%, you have invested 1 lakh and you are getting 6,000 interest, means how much? 1 lakh 6,000. But the prices of goods and services have increased by how much? 8%. Means what? Your return is only 6%. But how much of rates got increased? How much of percentage of rates got increased? 8%. So what is your real return? You have earned only 6%. But how much you have to pay? 8%. So what is the loss? 2%. This is because of what? Inflation. So this is called what? Inflation risk in investment. Now third risk under systematic risk is interest rate risk. Interest rate risk is the risk of losing our money or earning lower returns because of changes in interest rates. Here I will take the example of bond investment, right? Say you bought a bond that pays 6% interest. Later, if market interest rates rises to 8%, then what will happen? So here investors prefer only bonds with 8% interest. So value of your 6% bond falls. So when interest rate moves in the opposite direction of bond prices, investors face interest rate risk. So interest rate risk is the risk that changes in interest rates will affect the value of investments. So if you see in this slide, if interest rates are falling, then what will happen? Bond prices will increase. Say if interest rates are rising, then bond prices will decrease. Like this, investors face risk because of interest rates. Next, fourth one under systematic risk is called liquidity risk. What is liquidity risk? It is the difficulty of converting our assets into cash. Say for example, you are owning 2 flats and 1 plot, but all these are called what? Fixed assets. But when we want to convert that fixed assets into cash form, is it possible easily here? No, because it is very difficult for us to find a buyer to convert that fixed asset into liquid form. Means to buy that particular flat or plot, we have to wait for the buyer. That buyer may come immediately or within a month, or it may take months together to get a buyer, right? So what is the risk that we are facing here? Liquidity risk. Because of liquidity risk, will be having the problem of low cash. Say if you are having some debts, we have taken some loans from banks. Now we cannot repay those loans because we are having low cash with us. But we are having buildings, we are having flats, we are having plots, but it is very difficult for us to convert that particular fixed assets into cash form. Before making any investment, think twice or thrice, because sometimes we may have to face liquidity risk. Now we are coming to unsystematic risk. In unsystematic risk, we will cover 3 risks. What are those 3 risks? Business risk, financial risk, credit risk. So first we will discuss about business risk. This business risk is caused due to factors that are affecting a particular company's operations or its profitability. So why these risks are occurred? Because of what factors? One is increase in raw material cost or loss of key employees or machinery breakdown or decrease in demand for our products, or sometimes maybe change in government policies or regulations for our particular business. Because of these factors, we may have to face business risk. So if the company is having high business risk, then that may lead to lower profits or uncertainty to investors. Then what will happen? Investor concern will increase. This may lead to decline in share prices or lower returns to investors or higher risk of loss. If the company can control its business risk factors that are affecting business operations and profitability, then definitely the company can increase its profits in future, and the business can have good growth. Next, financial risk. What is financial risk? The possibility of losing money or earning lower than what we have expected. If our returns on investment are affected because of improper method of financing, it is called what? Financial risk, right? So why this financial risk occurs? Because of large debt servicing problems or short-term liquidity problems due to bad and doubtful debts or delayed receivables, and fall in our current assets or rise in our current liabilities. So these problems could no doubt be solved, but they may lead to fluctuations in our earnings, profits, and dividends to shareholders. So what we can do to reduce this financial risk? Proper financial planning and other financial adjustments can be used to correct this financial risk. In this way, we can control our financial risk. Remember one point here: risk cannot be eliminated completely, but we can identify that particular risk, understand that particular risk, and manage that wisely so that we can have better investment decisions. Now coming to credit risk under unsystematic risk. So when borrower may fail to repay obligations, then what will happen? We may have to face credit risk. When this credit risk occurs, poor financial condition of borrower or decline in cash flows and profits. Credit risk is the risk that a borrower or issuer will fail to meet its financial obligations on time. Means when the borrower or issuer of securities may become insolvent or may default or delay the repayment of principal amount or interest amount, because the borrower's financial position might have worsened and gradually may reach an extreme form of insolvency. In that case, the investors obviously get no return or less return. So what we should do before investing, we have to check the credit rating of the company, and then only we have to make investment. We'll see what are the key takeaways of our today's topic. Here you have understood what is risk. When there is a difference between actual returns and expected returns, there is risk. And next takeaway is, when we are expecting higher return, we have to take higher risk. Next, systematic risks means what? Which are affecting the entire market and which can't be diversified away. Next, unsystematic risk. These are company specific risks and which can be reduced through diversification. We can diversify and we can reduce that. Next one, if the investors can understand all these different types of risks, then they can take better investment decisions. So successful investing is not about avoiding risk, but what we have to do, we have to manage our risk effectively. That is very important. Now I want to conclude that the goal of our investment is not to eliminate risk, but to manage that wisely. So how to manage that wisely? You invest wisely, diversify smartly, and manage risk to achieve your financial goals. Risk is an unavoidable part of investing. Every investment carries some degree of uncertainty, but understanding the different types of risk can help us to make informed investment decisions. Remember, successful investors do not avoid risk completely. They understand, measure, diversify, and manage it effectively. So that is what we have to understand in managing risk in investment management. That's all for today. Thank you for watching. If you found this video useful, please like, share and subscribe to Finance and Accounting Academy channel for more easy to understand finance and investment concepts. See you in the next video. Thank you.